Question for you. What if the biggest market signal right now is not in the S&P 500? It's not in the NASDAQ. It's not even in rates or inflation, but in what hasn't worked for more than a decade. Today's chart is not about price. It's about relative power again. It's about rotation. It's about a market that may be quietly preparing a leadership shift that almost no one is positioned for. I know you don't hear about it, but that's how you make money. You need to be first. Remember, you need to be first. And there is a potential opportunity. What you're looking at now is the relative performance ratio of emerging markets now, not small caps, but emerging markets versus the S&P 500. And here again, it's not about narratives or CNBC headlines. It only tells you who is winning and when that trend changes. And right now, this chart is flashing a signal investors have not seen in years. Before we interpret the signal, we need to understand what this chart is actually saying and what it is not saying. This is a ratio chart, right? When the line rises, listen to me carefully, when the line rises, emerging markets are outperforming the S&P 500. When the line falls, the US equities are outperforming emerging markets. And notice something critical. There are no absolute prices. Absolute price is when you look at the stock market price. It's not absolute, it's relative. No dollar values either. This is just relative strength. That matters because markets rotate before headlines change. Now look at the time frame. We are spanning multiple years here, enough data to identify cycles, not noise. And finally, pay attention. Pay attention to the annotations. The purple curve markings highlight repeated rounded bottoms. The dashed horizontal line marks a long-term resistance zone, a ceiling that has capped emerging markets' relative performance for years. This is what is called a pattern recognition exercise, and patterns are the market's memory. So the repeating structure nobody talks about is the fact that we're going to focus on what's truly striking. Over and over again, we see the same structure. Emerging markets underperform for an extended period of time. The ratio grinds lower, frustrating investors. Sentiment collapses. A rounded bottom forms, slow boring invisible, and then quietly the ratio starts rising again. Eventually, it challenges the same resistance zone as we've seen it. The line. This has happened multiple times on this chart. Each time investors declare emerging markets unstable, uninvestable, capital crowded into US mega caps, again, valuation diverge, and then leadership rotated, even if only temporarily. This chart is not predicting timing, it is revealing regime behavior. And right now, we are back in that same resistance zone again. Only this time, the macro backdrop is very different. Let's be very clear. Markets never repeat perfectly, but they rhyme. In prior cycles, the US had clear productivity dominance. Capital was cheap. Global supply chains were expanding. Dollar strength was unchallenged. Today, almost none of that is true. There's persistent geopolitical fragmentation. There is reshoring and friendshoring. There's higher structural inflation. There's massive fiscal issuance. A dollar that is no longer uncontested. So emerging markets, by contrast, carry lower debt, are commodity-linked, benefit from supply chain realignment, and trade at historically depressed relative valuation. The chart is not technical. It's macro confirming, man. That's the reason why it's time to break the even line. When relative strengths dropped, falling despite higher US rates, strong US equity, and dollar resilience, this is a warning sign for crowded trades. The psychology embedded in this chart, this is where most investors miss the signal, because relative charts do not trigger emotion the way price charts do, like absolute prices. These are not all-time highs. No number go up, dopamine hits, right? This chart is showing you something more important, exhaustion. Every rally attempt in US dominance over the last year has produced less follow-through. Meanwhile, emerging markets refuse to make new relative lows. That tells you, A, sellers are exhausted. B, marginal capital is no longer reinforcing the old trend. And leadership is fragile. Markets rotate when conviction collapses, not when headlines turn bullish. And right now, this chart is screaming the US only trade is vulnerable. So what does this breakout actually mean? Let's talk about the dashed horizontal line. This is the line of denial. Above it, asset allocators are forced to reevaluate. Passive flow begins to shift and relative benchmarks stop justifying US overweights. A confirmed breakout here would mean sell everything US. It would mean global diversification starts working again. Valuation matters again and leadership becomes broader and messier. Historically, those environments favor real assets, favor cyclicals, favor countries tied to production, not financialization. This is not a crash call. This is a rotation call again. So the signal most we know is this. By the time emerging markets are back on the magazine covers, by the time analysts upgrade them in mass, by the time performance chasers notice, this ratio will already be far above this level. This chart is not telling you what to buy tomorrow, it's telling you what not to ignore today. Because leadership never changes loudly, it changes quietly. Then suddenly. And the investors who survive the next cycle are not the ones chasing narratives. They are the ones watching the ratios.